This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
I was talking with a friend of mine, Ben Gamgee. He's a realtor in Minneapolis, Minnesota. We were just talking about how it is so bizarre that the most widely anticipated report of the month is an inflation report.
I'm so excited, and I just can't hide it.
The inflation report for September came out today, which is October 13th, Thursday, and it was, as usual, hotter than expected. On a 12-month annualized basis, inflation is up 8.3%. That is down from the last couple of months, and certainly down from the high, which was back in June, over 9%, but still, inflation clearly remains stubbornly high, and this is the number one reason why the Fed and other central banks have had to raise the short-term interest rates so aggressively to try to get this number down. But doing that has become increasingly difficult. If we just flip down here to the different categories, we can see where some of this inflation is coming from. So month over month, CPI, which is seasonally adjusted from the preceding month, was up 0.4%, which if you annualize this number, it would be a pretty modest 4.8% going forward, still well above the Fed's stated 2% inflation target. However, I think the biggest concern really in this report continues to be the rising cost of food and perhaps most importantly, shelter. And both of these items, so particularly food at home, up 0.7%, and shelter also up 0.7%. These are items that all of us absolutely have to have. Food away from home is something we can give up. You know, new vehicles are up 0.7%, but you don't necessarily have to have a new vehicle, but everyone has to have shelter, everyone has to have transportation, everyone has to have medical care, and everyone has to have food at home. You also need electricity and utility gas service. You know, all of these kind of key items that all of us spend money on are basically all running at 0.7 month over month, or in some cases, a little higher than that. So if you just annualize some of these basic expenses, they are still running at 8.4% if you annualize this 0.7% number. And as long as inflation is running this hot, it's going to continue to put pressure on everyday consumers, which continues to put pressure on the economy, and that continues to put pressure on earnings and profits for both public and private businesses. So eventually, I think this is going to lead to either one of two things, right? We're either going to have people stop spending as much, stop demanding so much, or we're going to have some of the supply come back online, particularly from some of the labor market shortages that we've seen. We need people to come back to work and get that wage pressure pulled back down. But until one of those two things happen, we're likely to still see high inflation, which is going to lead the Fed to continue to increase interest rates. And as the old adage goes, don't fight the Fed. As long as we are fighting the Fed, the stock market is probably going to have a difficult time making a meaningful run higher. You also have a lot of other bad headlines. Obviously, Ukraine and Russia are still at war. You've got ongoing supply issues coming out of China, businesses kind of pulling away from China as a growth source, trying to come up with alternative ways to manufacture their goods. So you just have a laundry list of really bad things. Mortgage rates obviously higher, putting a lot of pressure on the housing market. You know, this ongoing supply shortage in real estate has caused, rent to increase and probably shows very little signs of relenting. So all of this bad news really across the globe is really putting a major damper on the stock market. Obviously, we've seen that. The bond market also struggling as well. Pretty much any asset in 2022 has gone down, and by a lot. So the question everyone's asking and trying to answer is, how much more downside could we have? I attempted to answer that question in a video I posted for premium subscribers. Thank you to everyone who is subscribing, supporting me on YouTube Premium as well as Patreon. And I posted a video for you guys reviewing the S&P 500 valuation model. And my conclusion there was basically at the time, there wasn't a significant buying opportunity, in my opinion, for stocks. I think a lot of the damage we've seen so far this year has really been because rates have gone up so much. I don't think we've really seen all that much of a negative impact yet from increasing recession odds. I think we're starting to see those priced in a little bit, but there is one thing, I think probably just one thing that gives me confidence that this may be almost over. Pretty much everything else points to continued difficulty, but I did want to point out this one thing that I did see from a website, and that is the bull-bear ratio. So every week, Investors Intelligence basically surveys a bunch of retail investors like you and me and says, hey, do you think the stock market is going to go up or down over the next 6 to 12 months? And they basically just calculate how many people say it's going to go up and how many people say it's going to go down. And then they calculate a ratio. And they've had this ratio going back a long time. So you can actually find these ratios by searching. I'll put a link in the description below, but you can find it using Ed Yardeni, who's a popular economist. Yardeni Research Incorporated is a well-respected firm that publishes research to institutional clients, but he has these chart packs, which are absolutely fantastic. Would highly recommend checking them out. But you can see he updated this one as of yesterday, Wednesday, October 12th. So this chart is the bull-bear ratio. Anytime that was under 1, meaning there were essentially more bears than bulls. So for example, let's say they survey and 1,000 people say that the stock market's going to go up and 2,000 people say the stock market's going to go down. Well, that ratio would be 0.5, which is obviously less than 1. So if it's less than 1, more bulls or more bears than bulls, you see these kind of green bars. And you can see that, generally speaking, when those bars are there, the future returns for stocks have actually been, pretty good. So you get quite a bit of green here following the flash crash in 1987, right? So basically buying all of these shaded would have been a really good idea. You also have a good buying opportunity here. The green, the market spikes, and then here again. And then, this was sort of a difficult period in the mid-90s, but obviously buying here would have led to extraordinary returns. Basically all of these little market blips were close to, maybe not always at a bottom, but a decent time to be buying stocks. And it's really worked quite sensationally as of late. Go back to 2010, and basically anytime you see a green bar, that is almost always signaling a little buyable dip buying opportunity. Where you don't see that, where it's been quite a bit early, is really back here in 08. You had a bull bear under 1 here, which did lead to a rally, but that ultimately gave way to the financial crisis, and basically everyone was bearish this entire time. So could we be going back into a situation like this? Yeah, you certainly could. There are enough fundamental issues. You just need something to break and break badly. I doubt we would end up going back to something like an 0809, but anything is possible. But the point is, anytime you have a market, the price is dictated by buyers and sellers, right? So if the price is going down and then all of a sudden it goes up, the absolute lowest price is the point at which the very last person sold their stock. There was no one really left to sell and you only had buyers. So more buyers than sellers pushes the price higher. And generally, the point at which you reach no more sellers is the point that you have peak pessimism. There is a significant amount of pessimism. In fact, right now, investors are as pessimistic as they've been at any point since March of 2009. So as of October 11th, the bull to bear ratio was at 0.57, well below the 1% criteria we looked at earlier. Here's where we're at right now. And you have to go all the way back really to here, March of 2009, to see a reading that was lower than this. You got pretty close at several points, but This is a tremendous amount of bearishness. This chart shows the breakdown of people that are outright bullish versus outright bearish, and the remainder would just be basically neutral. So this green line tells us the percentage of people that are bearish. That is at 44.1%. And again, we see this reading is basically as high as it's been since 2011. So the most bullish piece of information we may have right now is the fact that everyone else is bearish, right? If everyone is bearish, that means that everyone that was going to sell their stocks is either sold or really thinking about it. So hopefully that means we're getting to the point where this is a buyable low. I personally have my doubts that we've seen the bottom. I think there are a lot of fundamental issues. The other thing I think is that you've seen virtually no interest from insiders. And usually you see a lot of insider activity start to pick up when the market starts to sell off. Maybe I can show an update on the insider activity in a future video. Let me know in the comments section if that's something you'd be interested in. But by all accounts, it seems like everything is just really falling apart. You've got major fundamental issues, but everyone knows that. Everyone has, been thinking of how bad of an environment this is. So maybe, just maybe, we have gotten exceptionally bearish, which is ultimately exceptionally bullish for long-term investors. Maybe we have more short-term downside ahead, but again, like I posted in my video a couple weeks ago, I'm not personally selling because I don't think I know, when to sell, when to get back in, and ultimately, I don't think it makes that big of a difference over the long run. Just basically adds a lot of stress to my life, right? Having to try to guess all of these different points of entry and exit. There are a lot of people playing that same game, and to win it, you have to be better than everyone else. And I'm not entirely confident that I am better than everyone else. So with that being said, I'm going to continue to be consistent, buying with the idea that I'm not going to need this money for another 10 years. Now, if you're someone who is retired, maybe thinking about retirement in the near future, you may be in a different situation. Maybe you want to be a little bit more conservative here, just in case this does get worse. Obviously, you're needing the money sooner than I am and other people that are maybe younger and still saving. But for me, I am going to continue to, basically invest dollar cost average. Basically, anytime I get money, I'm going to add it to the markets. Whatever your time horizon is, that's what you should be focusing on, not what happens over the next month or even year or even 2 years or 3 years. That is ultimately irrelevant. And if you're buying, actually, that's a good thing, right? Because if you're buying stocks lower and lower and lower, and they're ultimately going to be whatever they're going to be in 10 years, you benefit from buying at lower and lower prices. So that's the mentality I'm taking. It's a lot easier and less stressful that way than worrying about, the next month or two. But definitely short-term outlook looks pretty bleak. So certainly save up, have an emergency fund, if you get laid off or whatever, you need money for something. You certainly don't want to be selling and using your portfolio at these levels. So, just build that emergency fund, be conservative, pay off debt, whatever things you need to do. But if all of that is behind you, you're on a solid financial footing. I don't see a reason to stop buying stocks or to sell what I already have. So thank you for watching, and I will see you in the next video.